Welcome to This Explainer. Today we're taking the incredibly dense and frankly kind of intimidating IAS 32 rulebook and we're transforming it into a clear visual guide. If you work in finance, accounting, or honestly if you just want to truly understand how companies report their real financial health, well, you know that the line between what a company owns, what it owes, and what actually belongs to its shareholders, it can get incredibly blurry. So let's cut through all that accounting jargon and master the true nature of financial instruments together. Let's dive right into the fundamental tension at the very heart of IAS 32. Is it debt or is it equity? Now, I know it sounds like a totally simple question, but it's actually one that companies often try to obscure. Why? Well, to make their balance sheets look a whole lot healthier than they actually are. You see, by classifying a tricky financial instrument as equity instead of debt, a company can artificially lower its leverage ratios, making them look way less risky to investors. And IAS 32? It was built specifically to prevent exactly that kind of financial camouflage. To navigate this standard, we're going to use an anatomy and exceptions framework. We'll be covering defining financial instruments, the liability versus equity divide, splitting compound financial instruments, treasury shares and returns, and finally, the strict rules for offsetting. Okay, Section 1, defining financial instruments. This is the baseline DNA. Let's get right into it. First up, what exactly is a financial asset? Think of it essentially as your contractual right to receive something valuable. That could be cash, it could be the equity instrument of another entity, like owning shares in another company, or it could be a contractual right to receive a steady stream of cash, like a trade receivable or a loan you've given out. It can even be a right to exchange financial instruments under conditions that are potentially favorable to you. But the absolute keyword here is contractual, right? This isn't just some vague promise, it's a legally enforceable agreement. Now, on the flip side of that, we have the financial liability. And this acts a lot like a pair of contractual handcuffs. It means you have a strict, unavoidable obligation to deliver cash or another financial asset to someone else. It could also mean you're obligated to exchange financial assets or liabilities under conditions that are, well, potentially unfavorable to you. A classic example would be a bond you've issued, or just your simple accounts payable. Bottom line, if you owe cash and you absolutely cannot legally avoid paying it, you are looking at a financial liability. And finally, we have the equity instrument. Think of an equity instrument as just the residual ticket. It's whatever happy little slice of the pie is left over after all of your strict, unavoidable liabilities are fully deducted from your assets. Crucially, it carries absolutely no obligation to deliver cash. So if you buy an ordinary share in a company, you're holding an equity instrument. You get what's left, but the company isn't contractually forced to hand over a single dime to you. Moving on to Section 2, the liability versus equity divide. Let's look at how this plays out. So here is that great divide in action. A liability is defined by the absolute obligation to deliver cash or assets, whereas equity is defined by the absolute lack of that obligation. IAS 32 makes it super clear. If an issuer lacks the unconditional right to avoid paying cash, it's got to be classified as a liability, plain and simple. And get this, even if your ability to pay is restricted because you lack foreign currency or maybe it requires regulatory approval, that doesn't magically negate the obligation. You still have a liability on your hands. So, the absolutely crucial point here is our ultimate reporting mantra: substance over legal form. What does this actually mean in practice? Well, let's say a company issues something they legally name a preference share. Now, the word share sounds an awful lot like equity, right? But wait. If that specific contract requires mandatory redemption by the issuer for a fixed amount at a fixed future date, it really doesn't matter that they called it a share. The true economic substance is that the company is literally forced to pay out cash in the future. Because of that, IAS 32 demands it be treated as a financial liability. You just cannot hide a debt obligation behind a fancy legal title, no way. All right, Section 3, splitting compound financial instruments. Let's talk about splitting these financial shapeshifters. A compound instrument is basically a hybrid. The most common example you'll see is a convertible bond. From the issuer's perspective, the single instrument actually contains two completely separate components baked right in. First, there's an obligation to make scheduled payments of interest and principal, so that's your liability. Second, there's an embedded call option giving the holder the right to convert that bond into a fixed number of ordinary shares, and that is your equity instrument. IAS 32 dictates that these shapeshifters have to be forcefully split upon initial recognition. You can't just take the easy way out and lump it all together as debt or all as equity. Now, there is a very specific sequence to this splitting process. IAS 32 requires you to calculate the fair value of the heavy liability slice first. You do this by figuring out the present value of the future cash flows, and you discount that at the market rate for a similar bond that doesn't have a conversion option. Then, and literally only then, do you take the total fair value of the entire instrument, subtract that liability amount you just found, and whatever residual leftover value remains gets classified as the equity option. It perfectly mirrors our definition of equity from earlier, right? It's the residual interest that's left over. And a quick side note here, no gain or loss actually arises from initially separating these components. Moving to Section 4, Treasury Shares and Returns. Let's see how we deal with a company interacting with its own equity. When a company goes out and reacquires its own equity instruments, we call those treasury shares. And IAS 32 strictly states that these treasury shares must be deducted directly from equity. This is a massively important rule. No gain or loss shall be recognized in profit or loss on the purchase, sale, issue, or cancellation of an entity's own equity instruments. Any consideration paid or received, it goes directly into equity. So no, you absolutely cannot boost your profit and loss statement by successfully day trading your own company's stock. You see, the initial classification of the instrument directly determines how you account for its returns. If an instrument is classified as a financial liability, things like interest, dividends, losses, and gains relating to it are recognized as income or expense in profit or loss. But if it's equity, distributions are recognized directly in equity. So remember those mandatorily redeemable preference shares we talked about earlier? Because they are liabilities in substance, the dividends paid out on them are treated exactly like interest on a bond. They are an expense that directly reduces the company's reported profit. And honestly, this is exactly why getting the classification right on day one is just absolutely critical. Finally, we've arrived at Section 5, Strict Rules for Offsetting. Let's look at the criteria for netting. Now, companies love to offset assets and liabilities because showing smaller netted numbers makes the balance sheet look way leaner. But IAS 32 acts kind of like a strict bouncer at a club here, requiring a very rigid two-key system for offsetting. To present a net amount, you must currently possess both the legally enforceable right to set off the amounts and the actual intention to either settle on a net basis or realize the asset and settle the liability simultaneously. And that right of set-off, it cannot be contingent on some future event. It has to be legally enforceable in the normal course of business, in the event of default, and even in bankruptcy. So if you just have the intention to net them, but not the ironclad legal right, you cannot offset. So the crucial takeaway here is that clever financial setups do not automatically qualify for offsetting. For instance, if you acquire several different financial instruments to emulate the features of a single one, what the industry calls a synthetic instrument, you generally cannot offset them because they involve entirely different contracts and risks. The same exact logic goes for assets pledged as collateral for non-recourse liabilities. Even those complex master netting arrangements, which financial institutions use heavily to protect against bankruptcy, well, they don't provide a basis for offsetting unless you actually intend to settle net in the normal course of business. The standard deliberately forces companies to expose their true gross credit and liquidity risks unless simultaneous settlement is virtually guaranteed, like, say, through a market clearinghouse. As we wrap up, we're going to leave you with this final, somewhat provocative rule to ponder, straight from the text of IAS 32. If you cannot unconditionally avoid paying cash, you are holding a liability. It's such a simple sentence, right? But it has massive world-altering implications for global finance. It forces transparency, and it completely strips away the legal illusions that companies sometimes try to weave. So the next time you look at a set of financial statements, I want you to ask yourself, are you just reading the legal titles? Are you actually seeing the true economic substance of the contracts being held? Thanks for joining us on this explainer.